Hi guys, welcome to Investify, where we help you grow your wealth through smart investments. Today we will talk about the Federal Reserve just flipped. After a seemingly endless wait, they've hit the pause button on their rate hikes, signaling the start of a whole new market cycle. It's like a wild roller coaster ride that's about to shake up everything from stocks to home values to your precious savings accounts and even credit cards. But fear not, because today we're diving headfirst into their major changes. We'll unravel what it all means for the market, decode the Federal Reserve's latest comments, and uncover some sneaky money-making opportunities along the way. So get ready for a thrilling ride through the twists and turns of this financial roller coaster. Let's get the show on the road. It comes as no surprise that the Federal Reserve has been actively combating inflation, and to everyone's surprise, their efforts seem to be paying off. Let's take a step back to March 2022 when they first raised rates by 0.25%, signaling the end of easy money and introducing the term Quantitative Tightening, which sends shivers down investors' spines. In the prior years, the Federal Reserve had promised to buy endless amounts of corporate bonds and mortgage-backed securities to stimulate lending. When investors withdraw, they stepped in to purchase assets, providing reassurance. However, now they face the task of selling those assets, known as quantitative tightening. Consequently, yields have risen, assets values have fallen, and interest rates have soared at an unprecedented pace. But how are things truly faring? The latest inflation report as of June 13th shows a significant improvement, with a year-over-year increase of 4%. This marks the lowest reading since 2021, and month-over-month there has been a mere 0.1% rise. This positive trend leads many to believe that the battle against soaring prices is gaining ground. However, concerns remain as core inflation, excluding food and energy prices, stubbornly hovers around 5%. Notably, shelter costs have surged by 0.6% in the past month alone. While the overall report appears encouraging, there is still work to be done to rein in inflation and ensure it continues moving in the right direction. Furthermore, let's examine the chart that highlights the specific categories experiencing the most significant price fluctuations in our economy. While inflation gradually easing, the markets are ecstatic. However, a closer look reveals an intriguing reality. While the S&P 500 appears to be soaring, it is mainly driven by a handful of superstar stocks. CNBC reports that the median stock is actually down 0.2%, with the overall gains stemming from just 5 companies: Apple, Microsoft, Google, Amazon, and Nvidia. Interestingly, if we were to exclude 2 other prominent companies, Tesla and Meta, the S&P 500 would actually end up slightly negative for the year. This may seem surprising, but historical data shows it's not uncommon. A finance professor at Arizona State University found that, on average, stocks traded for just 7 years and often incurred losses even with reinvested dividends. Astonishingly, the most frequent outcome for individual stocks is a complete loss of value, with less than half of all stocks delivering positive returns. To add to that, out of the 26,000 stocks analyzed, a mere 1,000 accounted for all the profits since 1926. Even more striking, a mere 86 stocks were responsible for half of those gains. This data reveals that just 4% of publicly traded stocks in the last century have outperformed a 1-month treasury bill in terms of generating higher returns. In light of these statistics, it becomes evident that navigating the stock market can be a treacherous journey, highlighting the importance of careful analysis and diversification in investment strategies. This historical pattern reveals that the ever-changing landscape of the largest companies leading the market is completely normal. So, the confirmation of a new bull market, the stock market is exceeding expectations. However, how does this impact the housing market? Redfin's monthly report sheds light on the situation. In May, they found that homeowners were reluctant to list their properties due to the near 7% mortgage rates, resulting in record low new listings. Consequently, home sales were limited, keeping prices relatively stable with a modest 1.6% year-over-year decline. The housing markets experiencing the largest declines include Austin, Texas, Oakland, California, Las Vegas, San Francisco, and Phoenix. On the other hand, Cincinnati, Miami, Milwaukee, Fort Lauderdale, and Virginia Beach have seen increases ranging from 4% to 13%. Redfin also noted a 22.7% decrease in new homes listed for sale compared to last year. Surprisingly, more people feel it as a good time to sell, suggesting that higher prices are not deterring buyers, and that sellers are achieving their desired prices. For those patiently waiting for prices to fall, there is some good news in the rental market. Thanks to a construction boom, there is an abundance of new rental units available, the highest since 1973. This means you could potentially save money by renting. However, a recent Redfin study revealed that only 4 major metros, Detroit, Philadelphia, Cleveland, and Houston, were cheaper to buy than rent. Outside these locations, owning a home at a 6.5% interest rate could cost twice as much as renting. In summary, while the stock market thrives, the housing market faces challenges due to the mortgage rates, impacting inventory and sales. However, rental options have increased, providing potential savings in certain areas. Currently, buying in many cities may not make much short-term financial sense due to the mortgage rates and homeowners' reluctance to give up historically low interest rates. With more inventory listed for rent, renters can take advantage of this situation. As for the Federal Reserve's recent announcement, they have paused the rate hike for June, ending a streak of 10 consecutive hikes. However, this doesn't mean we're in the clear. If inflation remains persistent, they are prepared to raise rates again, with projections of 2 more hikes before year-end. This unexpected news puts downward pressure on the markets, and we can expect another rate hike in July and possibly one in September unless inflation shows signs of decreasing. The stock market reacted negatively to the announcement, but a slight pullback is not unusual. It appears that the Federal Reserve has reached its overall interest rate target, allowing them to focus on fine-tuning the economy to gradually reduce inflation without causing a major downturn. Despite a few setbacks, such as failed banks and persistently high inflation, we seem to be heading towards the elusive soft landing that was deemed improbable just a year ago. Unemployment and inflation rates are relatively stable, and the strong job market can absorb temporary raises in unemployment without significant hardship. This suggests that we may experience temporary pauses in rate hikes as needed, with the potential for future hikes. Hopefully, we can eventually return to a semblance of normalcy. What are your expectations for the economy moving forward? Share your thoughts in the comment section below. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.